So you're buying a home, you've saved your down payment, and lo and behold, you found out you have to pay closing costs on top of that down payment. But were you prepared? Well, you will be after watching this video. I'm Brand the Mortgage Man, and I've helped more than 10,000 home buyers over my 20+ year career in mortgages, and today I'm here to help you. In this video, I'm not going to talk about the down payment that you need for your home. You know you need a down payment. What I'm going to talk about are the closing costs that come along with the purchase of any property. And more important than that, I'm going to itemize out what you should expect when you're buying a home here in Florida and it comes time to pay those closing costs. So let's get right into it. Closing costs are the costs that you have on top of your down payment. Good way to look at this are your closing costs are basically monies that you will not get back if you sold the home the day after you closed on it. Unlike your down payment, which becomes equity in your property and belongs to you. Closing costs come from multiple sources or multiple parties that are involved with your transaction. If you're watching this video, you're likely going to be using a mortgage to buy your property. So you're going to have charges that come from the lender, charges that come from what I call miscellaneous third parties, like an appraiser, the credit report that you need for the property. You're going to need a property survey. You're going to have charges that come from the title company. The title company is going to be the company that actually determines whether or not there are any liens or encumbrances on the title to the property you're buying, and they charge for that. There are government charges in Florida, both from the state level and from the city and county. You're also going to have to set up an escrow account. Escrow account is where taxes and insurance get held and collected from you on a monthly basis. However, that account needs to be established on the day you close on a property. On top of that, you have something called prepaid items. Prepaid items are things like the interest on your new mortgage from the day you close through the end of the month in which you're closing, the insurance policy on your new home to cover you from the day you closed all the way until that same day the following year. So this is all very, very important because in some cases your closing costs may exceed what your down payment is, right? So you want to keep this in mind. So I'm going to itemize this out for you, and I'm going to use a $400,000 loan amount in order to do that, because most of the costs that you're going to see are going to be related to what you're borrowing. Not all, but most. So I think using a $400,000 loan amount will be fair to at least give you a general idea of what to expect when it comes to closing costs on a property. So what we're going to start with, right, for one, I'll put this here just so you remember what we're basing everything off of. So we're going to say a $400,000 loan amount. So what we're going to start with are the lender-related charges. So these can vary, depends on the lender that you're working with, but what I'm going to show you are what the more common lender-related charges would be. So for one, processing fee. So just so you understand, a processor is the liaison between you as the borrower and the underwriter on the loan. The underwriter is the final decision maker when it comes to the credit, right? Are they going to approve your loan and issue what we like to call a clear to close for that loan so you can actually close on the property? But the processor is going to help work with you and the underwriter. They're going to collect all your updated income documents, your asset documents, credit documents, right? They're going to work directly with you to answer questions that the underwriter might have regarding your work history, or not just work history, but it could be, where you've lived for the last few years and getting clarification on those things, maybe inquiries on your credit report. So there's different things that the processor is going to be involved with to help you move the loan through underwriting. So lenders are going to charge a processing fee. So I'm just going to use what we charge. It could vary from one lender to the next. I'm going to use our fee. So we charge $720 for processing. On top of that, I just mentioned the processor works with you and the underwriter, right? So then you're going to have an underwriting fee. I mentioned what the underwriter does. They're the final credit decision maker. Lenders are going to charge for that. So our underwriting fee, once again, is $975. So between these two charges, right, you have $1,695. It doesn't matter if you're borrowing $100,000, doesn't matter if you're borrowing $1 million. We charge the same amount regardless of your loan size. Now, there are lender charges, right, that could be less common that are based on how much you're borrowing. For instance, you may have to pay discount points. Discount points could be charged if you're buying a lower than market interest rate. And you may need a lower rate to qualify, or maybe just want a lower rate. So if you're paying discount points, right, one discount point, let's call it, is 1% of your loan amount. So if your loan amount's $400,000, you're paying 1%. Well, that means you would have $4,000 in discount points. Like I said before, this is not just something that everybody charges, nor is it a regular closing cost. However, it is a cost that you might incur if you're buying a lower than market interest rate. So these could be charges from the lender. Next, after the lender, you're going to have what I call your miscellaneous third-party costs. So miscellaneous third-party are going to be charges from third parties that aren't title, aren't the lender, right? They're services that are needed during the process, but they're from like random places is the best way to look at it. So one of those is going to be the appraisal. Appraisals run anywhere from about $550 to $1,000. So why don't we just call that $750 for now? It just depends on how complicated the appraisal is going to be, how quickly you're trying to receive the report, the type of loan you're obtaining. So we'll call an appraisal $750. But if you don't know what an appraisal is used to determine the value of the property. You agreed to pay one price, but the lender needs to have an appraiser go out to verify that what you agreed to pay is what the home is actually worth. If it comes in above that, great, but it needs to have appraised for at least what you agreed to pay for the property per the contract. The credit report. So part of getting qualified for a mortgage requires a lender to pull credit. Lenders can't charge you more than the credit report actually costs. You're going to pay what the cost of the report is, and it will list that on the credit report itself. But lenders pass that charge through in most cases to the borrower, but you're paying the credit report company directly. You're not paying the lender. So the credit report falls under miscellaneous third party for that reason. Now, credit reports are pretty expensive now. So an average credit report is about $150. On top of a credit report, if you're buying a home, and we're using the example, we're using a single family home, meaning it's not attached on either side, it's not a condo, right? You're going to need a property survey. So a property survey is going to determine the boundary lines of the lot. So it's going to show where the home sits on your property, what those boundary lines are, and it's going to determine whether or not you're encroaching onto your neighbor's lawn. Maybe you have a fence and it's going into the neighbor's lawn. A survey will help determine that. And title companies, which I'm going to get to next, are going to require a survey to issue clear title. So a survey is typically around $395. If you're buying a property that's on a larger piece of land or it's just more complex, just like an appraisal could be, it could cost more than that. But on average, a survey is $395. Now, the next entity that's involved with the transaction is the title company. So title, first of all, shows ownership to the property. The title company's job is a few different things. They're going to search title to make sure there's no liens or issues with title. There may be a mortgage on the property already. That would be a lien, but their job's to make sure that gets cleared before you close on the property or at the time you close on the property. You should be taking title, ownership of the home with only your new mortgage on title, right? So the title company is going to do that for you. They're going to also handle that closing for you, and they charge for that, right? They're going to notarize whatever needs to be notarized. They're going to sit with you, go through the closing package page by page, make sure you understand what you're signing and that it matches what you agree to with your lender and with the seller of the property. They charge for that. So the title company is going to charge a few different things. For one, they're going to charge a settlement fee. Right? The settlement fee can be a settlement fee, a closing fee, it's the same thing, right? That means they're preparing the paperwork, they're sitting with you, they're signing everything. On average, a settlement fee is $695. On top of that, you need title insurance, right? So there's two types of title insurance. And I'll break this out for you so you can see. So you have your title insurance, and there's a lender's title insurance policy, and there's an owner's title insurance policy. So I'll explain the difference between the two and what title insurance is. First of all, title insurance is a one-time insurance policy that, let's just say in the case of owner, which would be you're the owner of the property, you buy this policy one time, it protects you for as long as you own the property, but what it protects you against is anything that may have been missed at the time that the title company did their title searches and lien searches on the property. If they issue title insurance to you and they say there were no issues with title, and then let's just call it 2 years down the line, it turns out there was a private mortgage or some unpaid bill to a contractor that comes up, and it turns out that there really was a lien on the property. Well, because you have title insurance, that title insurance policy is going to pay out whatever's owed for that lien. You're not having to. Same thing applies to the lender policy. Same thing, but for us or whoever your lender is. It protects them the same way you're protected by your owner policy. The thing is, the owner policy is actually not required. It's completely optional. It's up to you if you want to have one. I've never had a client not get an owner policy. Lender policy is a requirement as long as you have a mortgage on the property. And here is how the title insurance is calculated in Florida. So lender's title insurance, right? It's calculated the same way, but we're gonna go off the lender policy since that's the policy that's actually required. So we're saying our loan amount's $400,000. So that's what they're gonna use for the title insurance calculation. So the first $100,000 of your loan amount is $575. That's the first 100,000. Every 1,000 after that is $5, right? So in this case, right, we take 400,000 minus 100,000 leaves 300,000. So in this example, we're going to take 300,000 times $5, and that's going to give us $1,500. You take the 575 plus the 1,500, and it's $2,075, right? This $2,075 is how much the lender's title insurance would be. It's required. The owner's policy, once again, I'll reiterate, is optional. However, when you get the owner's policy issued simultaneous to the lender policy, you actually get a discount on the second policy. So this owner's policy, on average, unless you're doing some massive down payment, which most people aren't, this owner's policy typically runs around $500. So you're getting a substantial discount because you would be paying closer to this $2,075. But because both are being issued at the same time, it's called a simultaneous issue discount, you're saving money. So between the two, in this case, it's just under $2,600. Depending on where you're buying, based on county, the seller may actually pick the title company and pay for this title insurance. So if you're buying in Broward or Miami-Dade County West, right, so you go out toward Naples in that area, well, the borrower or buyer picks the title company and pays for these things. If you're buying in Palm Beach County North, well, the seller typically picks the title insurance policy and pays for these things. So you actually save money on closing costs when you're buying in Palm Beach County or North than you do if you're in Broward or Miami-Dade, for example. So keep that in mind when you're looking to buy your properties if that's something that is important to you. If you're not really concerned about the exact location and you're just trying to save a buck or two when it comes to your cost, well, just buying in Palm Beach County or North is going to save you a few $1,000 depending on the price range that you're looking in. Now, on top of your title insurance policy, there are endorsements to that policy that are required. Now, these endorsements are essentially add-ons to the policy, and it can vary depending on the type of property you buy. Condos have specific endorsements. If you're in a flood zone, it can have a specific endorsement, right? So these endorsements tend to be just over 10% of whatever your title insurance is going to run you. So in this case, we're calling the title insurance $2,075. Let's just use the 10% number. I'll keep it real simple. Endorsements, about $210 for title endorsements, right? We said endorsements are add-ons to the title insurance policy. Top of that, the title company is going to do a lien search. So we'll call that a search. That's how they look for any issues with title. Call that $200. And then let's just say they do a title search. On top of that, another $200. So on average, this is what you're looking at for title fees on a $400,000 loan. About $695 to close, about $2,600 for the title insurance, endorsements of about $210, lien search of about $200, title search about $200. Right, so those are your title fees. Now, on top of title fees, I mentioned this early on, you have government charges. So let's get into those. We know what the government is, and in this case, we're talking about the state, right? So a copy of the mortgage and the deed. So mortgage is the instrument used, right, to finance the property. The deed is going to show ownership of the property. Those need to be recorded in public record to show that you own the property. There's a cost for doing that. On average, to record both, you're looking about $350. Now, the number of pages being recorded could affect that number, but $350 is a pretty good rule of thumb for what that should cost. On top of that, you have two different types of doc stamps. So you have a state stamp, and you also have a city-county. Now, the city-county is also called intangible tax, right? So the state stamp is equal to 0.35% of your loan amount. The city, county, or intangible tax is 0.2% of your loan amount. So once again, we're gonna do the math on here. 400,000, 0.35, I think is $1,400. And then 0.2 is $800. Right, my math right on that? Let me just confirm. I feel like I know math, but you never know. Mathematics. Yeah, that's right. So you have recording fee for the mortgage and deed, $350. State stamps, 0.35%, which would be $1,400 on this loan amount. City, county stamps or intangible tax, 0.2% or $800 on this loan amount, right? So they're your government charges. Now, these are all true costs, right, that you incur when you buy a property and have a mortgage. Now, on top of these costs, you have the prepaid items and the escrows that I was mentioning. So let's get into prepaid items first. So I mentioned that prepaids are going to be comprised of two things. One is going to be the daily interest. Two is going to be insurance. So daily interest, let's explain what that is first. So daily interest is going to be the interest on the new mortgage that you're obtaining. It's going to cover from the day you close on that mortgage or that house through the end of the month in which you're closing. So let's just say you closed on the 21st of the month and there's 31 days in the month. That would mean there's 10 days left in the month, right? Between the 21st and 31st, 10 days. So to figure this number out, and this number can vary substantially because it depends on when you're closing, what your interest rate is, and what you're borrowing. What happens is the lender's going to take your loan amount, they're going to multiply it by your interest rate, figure out what your interest paid in a year would be, figure out what your daily interest is, and then multiply that by the number of days. So let's just do this real quick. We said you have a $400,000 loan. Let's just say you're at 7% interest, right? So to do the simple math on that, we're gonna do 400,000 times 0.07, which will be 7%, gives us 28,000. You take that and you divide that 28,000 by 365, which is 365 days in a year, right? That gives us the amount of interest you pay per day using those numbers. So 76, in this case, 76.71 per day. And we're saying there's 10 days left in the month. Just in this example, I mean, you may be closing in the beginning of the month, you may have 30 days, right? And that's going to drive that number up. But we're going to take 76.71, we're going to multiply it by the 10 days, and that gives us $767.10 in daily interest. And you may say, why am I paying interest for the 10 days, right? I've just closed on the home. So you may have heard this before, but when you close on a mortgage and on a property, you actually don't have a mortgage payment in the immediate month following your closing. So let's just say it's February and you close at the end of February with 10 days left. You're not going to have a March payment. You won't pay until April. So what normally would have happened, because mortgage interest is actually paid in arrears, meaning it's paid behind, if you had a March payment, it would have paid the interest that accrued in February. But because you're skipping March, that interest still needs to be paid for the month of February. So you're paying it at closing. When you make your April payment, which would be your first payment in this example, you're paying whatever interest accrued for the month of March, and then so on and so forth, and that will carry forward. So that's being paid at the time of closing. The next is your insurance. When I'm talking about your insurance, I'm talking about homeowner's insurance. You're gonna pay the premium that covers from the day you close to that same day the following year. $400,000 loan here in Florida, let's just say that your insurance is about $3,600 for the year. This number can vary. I mean, it can be much higher than that. It could be a little bit lower than that, depending on where you're buying, the type of home you're buying, the age of the home you're buying, right? Keep all those things in mind. These numbers are not hard numbers, right? This is strictly just an example of costs you should expect to see. So prepaid items, in this case, you have what, just under $4,300 between those two items alone. And then the last part are your escrows. Now, this part can be confusing for a lot of people. So let me explain this part a little bit more detailed. Your escrows are going to be your property taxes and your homeowner's insurance. And when you make your monthly payment, and this is not I just want to be clear on something. You're not required to escrow your taxes and insurance. So talk to your lender, see if they give you the option to pay your taxes and insurance separate from your mortgage payment. Escrowing means that it's included in your payment, right? So you don't have to do that. Some people are surprised to hear that lenders don't require you to do that. but ask your lender if you're required to escrow. If you're getting an FHA mortgage, you'll be required, but if it's conventional or VA, you should have the option to waive escrow, meaning not include it in your payment. But let's just say you are including it because you prefer to do that for budgeting purposes. You need to establish an escrow account at the time you close on the property. So the way it typically works out is that when it comes to the taxes, and I'm talking about here in Florida specifically right now, for taxes, you're typically going to put 4 months of taxes into your escrow account. And when it comes to insurance, you're going to put 3 months. Now, here's a common question that comes up. People ask me, wait, so I'm putting 4 months of taxes, and I'm putting 3 months of insurance, plus I'm paying a year of insurance. Does that mean I don't have to pay my taxes and insurance as part of my payment for the first 4 months or first year? No, it does not mean that. The taxes and insurance do need to be paid if you're escrowing with your monthly payment from the time you make your first mortgage payment. The 4 months of taxes is creating a cushion in case there's a tax increase in the future when the new tax bill comes out for your property. And then it's also going to cover the month that you're skipping, right? I just told you a second ago that you're not going to make a payment in the month immediately following your closing, but you still have to have enough money in there to cover your taxes. Same goes for insurance. There's a cushion plus the month you're skipping. This way it helps prevent potentially a shortage in your escrow account when those bills come due. In Florida, taxes are paid between November and March. The bill comes out in November. Insurance is paid in the same month that you close, but the year following. So if you close in February, you'll have your insurance premium due in February the following year. They're typically 1-year premiums and 1-year policies. So just keep that in mind. But at closing, you're going to have to put money into this escrow account. So we said insurance was $3,600 for the year, which would be $300 per month, which in this case, and this is just an example, would be $900. Taxes, let's just say the taxes, I'm just going to use $400 a month right now, would work out to $1,600. Now, you may see when you go to close or you get an estimate from your lender for the taxes, they may show 10 months being collected, right? The amount being collected is really based on when you close and how close to the month of November you are when the tax bill comes out. And lenders are going to pay your taxes in November in Florida because it actually saves you 4% on your tax bill by doing that. However, even if they show 10 months, it should net out to 4. And what I mean by that is the seller of the property should be crediting you for the difference to get you to 4 months, because the seller is responsible for the property tax bill on that home from the first of this year, right? The first of the year in which you're closing through the day you close. They own the home during that time. So they're going to reimburse you for that period of time based on the amount on a per diem basis. So they'll take your tax bill the same way I calculated out the per diem interest. They'll divide it up by 365, multiply that by the number of days that have passed in the year up until the day you close, and you'll get a credit from the seller for that portion of the tax bill. So it should work out to about 4 months of taxes that you're responsible for at the time of closing, and then the 3 months of insurance, as I said. When you take all of these things and add them together, you can see it could be a pretty substantial amount on top of your down payment. So it's very important that when you're speaking to a lender, that they go over all of these details with you. You'd be surprised to hear there are many times that I get calls from new clients who were previously working with another lender, and they had no clue that they have all these closing costs on top of their down payment. So we make it a point here, my team and I, to take the time, explain everything in detail, and when we provide someone with a pre-approval, we let them know exactly how much money you're going to need or they're going to need for the purchase, inclusive of the closing costs. Now, keep in mind that you can always negotiate to have a seller give a credit toward your closing costs. The seller cannot give you a credit towards your down payment. So depending on the type of mortgage you're getting, you can determine the type of credit you're allowed to receive. Watch my video where I explain seller credits or seller concessions. They're the same thing, and the amount you're allowed to receive based on the type of loan and your down payment percentage, because it can vary. For more videos like this one and to learn about just mortgages and real estate in general, make sure to subscribe to this channel. And if you have any questions about your own scenario that you'd like answered, leave it below. I do reply to 100% of the questions left on my videos.